Why rising interest rates crash stock prices? Here's the real reason. Have you ever opened your investing app, seen a headline like Central Bank raises interest rates, and then a few hours later watched your green portfolio suddenly turn red? You might be wondering, what does an interest rate number announced by some central bank official have to do with the price of a stock you're holding? Today we're going to break this relationship down to its roots, so give me about 10 minutes. In this video, we'll cover three things. First, what interest rates actually are and who sets them. Second, the three main pathways through which rising interest rates can push stock prices down. And third, why the market's reaction to interest rates isn't always as black and white as the headlines make it sound, where we explain investing concepts in a simple way. As always, this is not financial advice. This video is purely for education, so you understand the mechanics behind the market, not a recommendation to buy or sell any specific asset. Okay, let's get started. Think of the benchmark interest rate, like the thermostat in your house. When the room gets too hot, in this case, the economy is growing too fast and prices are rising out of control, you turn the thermostat down. When the room gets too cold, the economy is sluggish, you turn it up. Central banks do something very similar with the benchmark interest rate. Formally, the benchmark rate is the cost of short-term borrowing between banks, which then ripples through almost every other interest rate in the economy. Mortgage rates, credit card rates, savings deposit rates, all the way to corporate bond yields. When the central bank raises this rate, borrowing money becomes more expensive across the entire system. Here's a concrete example. If the rate rises from 4% to 5%, a company that used to borrow expansion funds at 6% annual interest might now have to pay 7% annually. On a 10 billion rupiah loan, that's an extra 100 million rupiah in interest per year. That looks small on paper, but multiply it across thousands of companies nationwide, and the impact on the overall economy becomes massive. Alright, now let's talk about how this rate hike actually makes its way down to the stock prices sitting in your portfolio. There are three main pathways. Pathway 1, corporate borrowing costs rise, profits get squeezed. The logic here is straightforward. If A happens, then B, which causes C. Interest rates rise. A company's debt interest expense balloons. B, the net profit left over for shareholders shrinks. C, companies that grow by relying heavily on debt, often called growth stocks, usually get hit hardest through this pathway, since they depend more on cheap borrowing to fund expansion. A concrete number. Imagine a tech company with 50 billion rupiah in operating profit and 500 billion rupiah in variable rate debt. When rates rise by 1%, it has to pay an extra 5 billion rupiah a year. That's 10% of its operating profit, wiped out simply because interest rates changed. Pathway 2. Intrinsic value drops. 2. Remember the concept of intrinsic value we've talked about before. Calculating it is a bit like guessing next year's apple prices based on how many apples the tree can actually produce in the future. One of the most common methods, discounted cash flow or DCF, calculates today's stock value by discounting a company's future cash flows, using the interest rate as one of the key variables. And here's the catch. The higher the interest rate used as the discount rate, the smaller the present value of money you'll receive in the future. Say a company is projected to generate 100 million rupiah in cash flow every year for the next 3 years. At a 5% discount rate, the present value of that total cash flow is around 272 million rupiah. But when the discount rate rises to 8%, that present value drops to around 258 million rupiah, the exact same future cash, but worth less today. Apply this same logic across a company's entire multi-year profit projections, and you'll understand why rising rates can mathematically compress stock valuations, not just shake investor sentiment. Pathway 3. Money shifts from stocks into bonds and deposits. Here's something important to note. Investing is always a game of comparison. When deposit rates or government bond yields rise to, say, 6 to 7% annually with far lower risk, some investors start asking, why should I take on stock market risk when I can get a pretty attractive return with much more safety? Money gradually shifts out of the stock market and into fixed income instruments. This shift in demand is what helps push overall stock prices down. Let's compare two fictional companies to see how the impact can vary wildly. Call them Rapid Growth Company and Steady Company. Rapid Growth Company is a tech startup that isn't hugely profitable yet, relying on debt and far future profit projections to attract investors. When rates rise by 2 percentage points in a year, its stock drops around 28%, because most of its value comes from cash flows projected years into the future. And as we just covered, cash flows far in the future are the most sensitive to a rising discount rate. Steady Company, on the other hand, is a consumer goods producer with low debt and stable annual profits. Its stock only drops around 6% over the same period because its cash flows are closer to the present and it isn't nearly as dependent on cheap borrowing to keep operating. The difference is stark, 28% versus 6% from the exact same rate hike. I think you got the idea. Interest rates don't hit every type of stock the same way. But here's the catch. If you're concluding that rates go up, stocks always go down, that's oversimplifying reality. The market moves on expectations, not just numbers that have already happened. Sometimes the central bank raises rates, but stock prices actually rise because investors had already priced in that hike weeks or months in advance. Other times, rates don't change at all, but stock prices tumble anyway because the market is disappointed by the central bank's tone, which hints at further hikes down the road. This is also about collective psychology. When uncertainty rises, investors aren't sure whether the central bank will keep hiking or stop. Many people choose to play it safe, holding off on purchases, even selling off some of their holdings purely out of anxiety, not precise mathematical calculation. Warren Buffett once pointed out that in the short run, markets tend to reflect emotion more than pure logic, and a period of rising interest rates is one of the clearest examples of that. So does this mean you should panic and sell your stocks every time there's a rate hike headline? It depends on your investment horizon, the type of stocks you're holding, and how dependent that company is on cheap debt. Long-term investors holding companies with strong fundamentals often don't need to overreact to a single rate hiking cycle. But this isn't a black and white decision, and everyone needs to weigh their own financial situation and risk tolerance before taking any action. What's clear is that investing carries risk, and your portfolio's value can go up or down following dynamics just like the ones we've covered today. So now you know the three main pathways through which rising interest rates can push stock prices down. Ballooning corporate borrowing costs, intrinsic value getting discounted lower, and money shifting into fixed income instruments. Simple, right? Once you break it down piece by piece. If you enjoyed this video, please like and subscribe so you don't miss the next finance education video. Thanks for watching, and I'll see you in the next one. Bye.